What's going on, everyone? Welcome back to the channel. And in today's video, we're taking a deep dive into one of ICT most well-known concepts, the power of three. You might have heard it referred to as accumulation, manipulation, and distribution. But before we get into the structure itself, we first need to understand a few basics about how price actually moves within a candle. We'll go over what open, high, low, close, or OHLC actually means. And if you want to get a deeper dive into what those actually mean, you can check the top right corner. The video will be pinned in the top right corner. Then we'll connect that understanding to the power of three setup. Learn how to recognize it on the charts and study a few real examples so that you can start applying it on your own trading. Now, so let's start with the basics. When we talk about open, high, low, close, or sometimes open, low, high, close, we're describing the structure of a candle, especially on the higher time frames like the daily. Think of it like this. Price opens, form a low, pushes up to create a high, and then closes, completing the candle story. The sequence can vary depending on whether it's a bullish or a bearish day. But the key idea is that these movements form the framework for intraday price action. What we want to capture as traders is the expansion phase, also known as the mean movement of the day, where price delivers the bulk of the range. And that's exactly where the power of three comes into play. The power of three, or AMD, which also stands for accumulation, manipulation, and distribution. Now, let's go into that and break it down even further. Accumulation is where the market consolidates or ranges. It's a period of balance where liquidity builds up on both sides, with buy stop resting above the highs and sell stops below the lows. Then comes manipulation, where price breaks out of that range, but deceptively. It takes out traders that are positioned too early, triggers breakout entries, and sweeps liquidity on one side of the market. And finally, we have distribution, which is the true move, the expansion that delivers price in the intended direction after the manipulation phase. Think of it as like the market's rhythm. It accumulates orders, manipulates traders, and distributes price towards the target area. For example, when price is consolidating, that's the accumulation stage. Then we see a false breakout. That's the manipulation stage, which takes out traders who went long too soon or shorted too early. After that, price reverses and pushes strongly in the opposite direction, forming the distribution phase and completing the power of three. Now, let's talk about how to actually trade it. There are generally two ways I look for entries within the setup. First, I can look for a reversal during the manipulation phase, meaning I want to catch the turn right when the market completes its liquidity grab and begins expanding in the true direction. Here, I'll often watch for confirmations like displacement candles or entry models forming in that reversal zone. The second option is to look for a continuation trade during the distribution phase. Once manipulation has already occurred and price begins trending with strength, this is where you can target clean continuation setups in the direction of expansion. Now, let's visualize this. Suppose we're looking at a bullish power of three. During accumulation, the market is moving sideways. Then, during manipulation, it sweeps lows, trapping sellers and hitting stop losses of early longs. After that, we get a strong move upwards. That's your distribution. You can either catch the reversal right after the sweep or wait for a pullback entry during the expansion. The same logic also applies in a bearish scenario. Accumulation happens first, then manipulation sweeps the highs, trapping breakout buyers, and then finally distribution takes price lower. All right, now that we've gotten that theory down, let's move on to the charts and look at a few real examples so you can see exactly how accumulation manipulation, and distribution plays out in live price action. All right, now let's go ahead and take a look at an example of AMD. We're going to fast forward and see how price plays out and label each action within price. And as you see, price is consolidating within this seam range. Price is consolidating within this seam range, making this the accumulation stage. We'll mark this as red. And in the accumulation stage, we see a lot of consolidation. And that's exactly what price is doing. Price is consolidating within this box. Now, for the next step we're looking for is the manipulation. And when we're looking for manipulation, we need to see if price will sweep liquidity from the high of the accumulation box or from the low of the accumulation box. And that will give us our bias to where we should look for entries or where we should look for price to continue after the sweep of liquidity. All right, now let's fast forward a little more. And as you see, price wicks out to the bottom, sweeping sell side liquidity. And now that it's swept sell side liquidity, that gives us a bias that price may reverse the opposite way since it's swept liquidity from the low of the accumulation box and the low of the accumulation range. We see that price has swept liquidity from sell side. Now, let's go ahead and fast forward a little bit more. And just like that, we have our manipulation phase where price has swept liquidity from either buy side or sell side liquidity. Now, since price has swept liquidity from our sell side, we're intending for price to reverse bullish and continue the trend in a bullish manner. All right, let's see how price reacts after the manipulation stage. Now, as you see, we have a distribution in the bullish trend. And we'll mark this as green. So we have accumulation, manipulation, and distribution. Accumulation, where we had consolidation. Manipulation, where price either took out buy side or sell side liquidity of the accumulation range. And then we had distribution, where price reverses in the opposite direction that manipulation stage has took liquidity from. Okay, let's take a look at a next example. So here we are on the Euro USD dollar. We're going to see how it plays out. So as you see, price is consolidating within this same range right here. Let's go ahead and highlight this range. And we'll call this the accumulation box. Because within this range or within this box, price is accumulating. Price is basically consolidating. It has no clear bias to where it's going. It's just consolidating within that range. And as you see, price wicks out of the accumulation range, sweeping buy side liquidity from the old high. And that shows us manipulation. We mark this one as manipulation. And then, as you see, price then trades lower, making this stage the distribution stage because price has already accumulated, price has already manipulated. Now, only thing left for price to do is to trend in the next direction, making this a distribution stage. So let's go ahead and mark this out. We'll mark this as the green box. As you see, you have a clear power of three. Price has accumulation, price has manipulation, and price has distribution. And that's a wrap on ICT's power of three: accumulation, manipulation, and distribution. Start spotting these phases on your charts, and you'll be able to see the market in a whole new way. If you learned something new, make sure to drop a like, subscribe, and stay tuned for more smart money breakdowns and more content. I'm the Trading District, and I'll see you in the next one.